Good day, fellow deal makers. Welcome to the Deal Scout. This show is so fun for me because I go on a hunt for deals. I'm a deal guy. I love deals and I love talking with deal makers and learning about different types of deals. You're going to hear me say deals, deals, deals a lot in this show. There's a lot going on in the world of real estate and venture capital. And I wanted to go kind of find people who are making major investments into real estate based technologies and such. So I went out to LinkedIn and I found a guy named Lucas, and he's going to share some of the things that he's learned along the way. Lucas, welcome to the show.
Thanks for having me. Great to be here.
Yeah, man. All right. So, Lucas, tell us, who is Lucas?
So my name is Lucas, no relation to Justin, even though there is the last name in common. And I have co-founded a fintech-focused venture fund, aptly named Fintech Ventures. And we've been around since 2016, but have really been investing in earnest since 2019. And we're investing at the earliest stages of fintech and insurtech, so what we call pre-seed and seed. And we're investing anywhere in terms of 250,000 to 750,000 in pre-seed companies, and anywhere from 300,000 upwards towards $1 million into seed stage companies. And one of the areas that we're most interested in is real estate and how you can use certain regulations to go about syndicating larger transactions for anyone, regardless of their accreditation status or personal net worth.
Yeah.
So that's us in a nutshell.
Yeah. Super cool. I love what the industry did somewhere. I think it was like around 2015 is when this 2015 2016 is when we started to see a movement towards investments, right? In the past, and certain investments were only open to accredited investors, right? So there was this major gap between what people can invest in. Comes, and why don't you share kind of the story of what you saw and how you took that opportunity and ran with it, and now you guys are in some amazing investments. Why don't you share that story?
Sure. So it was actually in 2012 when something called the Jobs Act
Yeah.
was passed. And without getting too much into the nitty gritty of it, it basically allowed for companies to raise money under something called Reg A plus and then under Reg CF, which really allowed you, being the company, to go out and solicit money from anyone essentially within certain rules and regulations for not only your own company, but also to put into projects such as real estate debt or real estate equity. And so really we saw the first companies come 2014, 2015 into the space. And more recently, I'd say really within the last 2 years since COVID, we've seen a lot of other companies start to come into the space when it comes to real estate or to wine or to collectibles, you name it. And so it's been interesting to see, having been some of the first investors back in 2015 into a few companies that were using the Jobs Act to raise money for real estate, what's transpired and how there's been, like I said, a renewed interest in the space really in the last 2-3 years.
So,
So, yeah,
oh, this is so good, man. So good. Let's peel that a little bit. So you're seeing with it started, and you were right, like back way in 2012, like things started to progress, but you saw an interesting change that happened. So people were making investments, crowdfunding and investing in technology and in real estate, and you guys saw that, and you made your own investments. But you saw something happen in COVID, like during the time frame of COVID, where people were investing in collectibles. What the heck did you see there? Like, explain this. This is fascinating.
it's been interesting, and I'm still trying to point my finger to one sort of catalyst. I'd say people had more time on their hands as they were working from home. A great portion of the population received stimulus checks where they were putting it into investments in GameStop or AMC or Bitcoin, Shiba Coin, the list goes on.
Yeah.
But others were finding platforms that were providing alternative uncorrelated assets to, Bitcoin and to the stock market. And so we saw a rise in platforms that were offering investments in sports cars and sports cards, for instance, let alone companies that came to the space that were offering fractional ownership in rental properties or Airbnbs or you name it. And so this concept, like I said, Reg A Plus, Reg CF have been around for years, but we really saw, like I said, that second wave that came post-COVID, 2020 in terms of investors being interested. And now you're seeing with inflation, let's say over the last 6-9 months, really year to date, and economic uncertainty, there's been a continued interest into the space, especially for people looking for hedges against stock market volatility, against inflation, you name it. And so we're seeing that whether it comes to real estate, whether it comes to wine, and like I said, to other collectibles. I mean, you could go out and buy one of the first Apple computers and own shares in that. And people are doing that and they're interested in it. And you're also seeing some liquidity come back into the market in terms of these things are getting sold and you're making 20 to 30% in terms of returns over the course of a year. There's others that, are sold for less and people lose money, but the beauty of these platforms is they allow you to invest, anywhere from $10 to $100 in own shares, just like you would in stocks. So you can build a portfolio and, build something that's diversified that, in theory could be a nice complement to what else you're investing in, whether it's, your typical stocks, bonds. I even include crypto as a typical asset class now, just given the interest that people have.
Yeah. So this is fascinating that, the collectibles have been something that people are paying attention to. I think anytime there's volatility, it's going to create opportunity for innovation and creativity, right? So I'm looking at one of the groups that you mentioned that they do fine wine. So I can invest right now. I love wine. I'm a red wine kind of guy, but I could invest in a high end bottle. I might not be able to get to taste it, but I get to one day, hanging out with my friends, be like, yeah, I own a fraction of a bottle or something like that, like a 100-year-old bottle of whatever. And I think that's super cool. It connects people and it becomes a part of a conversation. Why are you why are you so interested in this world of fintech, crowdfunding, prop tech, unique things like this? And what's maybe the most unique thing that you have seen pop up on your radar as an investor?
So you talked about something I think is interesting and that really kind of compounded the interest in it, whereas that people like to talk about what they're doing with their friends,
Yeah.
and it does become to a certain extent bragging rights to say, hey, I own a collection of Bordeaux futures, for instance, which is one of the collections that this platform recently released, or hey, I own rare Japanese whiskeys where there's only several thousand bottles of this vintage produced in the world. And that doesn't stop at wine. As I mentioned, people are going in and looking at Babe Ruth rookie cards, et cetera, you name it, and talking to their friends, and they're already interested in sports, and now they can have a more tangible aspect of the game, even though they don't see the card. Although some of these platforms allow you to go into a Soho showroom, for instance, and go view what you own, a fraction
Wow.
of. So I think it's interesting because it really is, for lack of a better overused word, democratizing investing that's only really been available for the very small proportion of the US that's accredited investors. And so it's really leveling the playing field and offering, the ability to invest anywhere from 10 to $100 in a share of something or in a loan that returns, anywhere from 8 to 15% that's above market that you would be getting from a REIT or from a high yield bond even. And so in our view, we're interested in the fact that it really levels the playing field for retail investors to access strategies and even create their own strategies that have only typically previously been available to high net worth individuals or millionaires, billionaires, you name it.
Yeah. Lucas, why does that matter to you? All right. So you co-founded, your venture fund. Why does democratization of, investments, or maybe bringing some deals to the small fry, like why is that important to you? Or is it purely opportunistic?
Well, in my view, it's important because there's certain aspects of what we do as venture capitalists where we want to create wealth for others in terms of the founders of the companies.
Yeah.
And in certain regards, some of our companies have actually opened up their cap tables to allow the same investors that are buying shares of collectibles or real estate on their platforms to own equity alongside the investors such as ourselves. So we have one platform, for instance, that's raised over $30 million from individual investors, over 5,000 of them, and they sit directly alongside the cap table as ourselves. And so I'm passionate because I want to have aligned incentives when it comes to venture capital. And one way to do that is actually through crowdfunding to create ownership in the companies, not just the products that these companies are opening access to.
Yeah.
And so for me, it's really alignment of incentives and leveling the playing field and trying to make sure that everyone is in the same boat. And that's been important to me, whether it's through my professional life or, my personal life. And both of those blend in, and it's been great to be able to be part of these types of platforms from an investor, from a board member perspective.
Where's home for you? Where are you guys located?
So we are headquartered in Atlanta, Georgia,
Oh, cool.
and I am actually based in New York City, where my family is from. But I'm actually in Atlanta today recording this podcast, and Atlanta has been a special home for the fund. We have 4 companies here, and it's also a very interesting real estate hub, and I'd argue kind of an important, you could say microcosm for what what a growing city in the US looks like, from a lot of young people moving here for opportunities, a lot of technology jobs, and we think it's interesting to build companies here as well, kind of given those trends that are moving in positive directions.
Yeah, super cool. As you're making these investments and watching these companies grow, which is super cool, man. I love seeing progress. I love seeing businesses grow. I'm an entrepreneur through and through, and I love seeing these things. Like, what has been one of your most memorable deals that you've been a part of? Like, as you got involved and you saw something happen, you're like, that was one of my favorite deals.
So it's interesting because it's never a fully linear path, and that's been quite interesting to see. If you kind of look at, let's say, ranking all of the companies in terms of their progress, it would really look like a bunch of spaghetti all over, in terms of a lot of them would be going down and then coming back up, or some would start and come back down. And that's the fortunate when it works out and unfortunate when it doesn't work out. And in most cases, it doesn't work out when it comes to startup investing in terms of the returns. And so, I have a favorite deal that is, like I said, a company that we invested in called Ground Floor back in 2016. It was the first deal that we did from our fund, and it was allowing people, as one of the first movers, to have the ability, regardless of accreditation status, to invest in real estate debt that was backed by a hard asset, being a single family home. And that means that you could invest in a loan that was helping a home flipper go out and renovate a home and then sell it.
Mm-hmm.
And this company was one of the first movers when it came to offering securities under Reg A plus, and actually one of the first issuers to do so using certain regulatory advantages in the state of Georgia. They actually moved the company from North Carolina to Georgia in order to set up this structure. And I've enjoyed it, like I've said, because the company we invested into it in 2015, and then the company went out and subsequently has raised over $30 million from, like I said, 6,000 other investors, has 200,000 investors in the platform, and has allowed people to invest nearly 900 million into real estate debt. And now they're coming up with several other equity products that can get into at a later point, but it's going to allow people to actually invest alongside real estate developers for some pretty interesting types of projects and returns as well. So that one has a soft spot in my heart, not just because it's the first deal that we did, but also because it really comes into this theme of democratizing investing, because it allows people to invest in debt that they issue and curate on their platform, but also is allowing people to invest in the equity of the company. And you've seen some recent successes, and I hope that this company will be one of them in terms of companies that were crowdfunded and have IPO'd and or been acquired and created wealth for people that they may not have otherwise expected. And, you know, all of this comes with risk. And of course, I have to say, this is not investment advice, but we're seeing this wave, even, you know, 8-9 years post the creation of the Jobs Act, of people earning, you know, venture type returns, regardless of whether they're accredited or a VC or an investor in a VC fund. And I think that's fascinating, and I don't think that's going away. And I think it's really just starting. So that's kind of one of the deals that I'm most interested in, because it's creating potential wealth for people in the future.
So Lucas Timberlake, not related to Justin. However, that would be cool. Can you dance like him?
I cannot dance. The one, or nor sing. The one story that I do have, there's probably two, not to get too much off topic, but since you brought it up, is that the nurse that delivered me in the hospital, her last name was Timberlake, no relation. And people will slip in conversations and call me Justin, and I don't mind it. But the most interesting thing has been when they actually put it in an email and write it, because subconsciously I thought you would figure out that you'd be writing the wrong name. And, you know, it's funny because you'll get a few apologies saying, hey, I'm so sorry, I didn't mean to do this, I wasn't joking. And, you know, I don't take it personally, but it's just fun to see that happen.
It's a compliment, right? Like,
yeah, exactly. You know, so yeah.
Awesome. Well, I think we should start taking dancing lessons. Maybe not together, but like we'll do some dancing lessons, and then we should have a dance off. You, Timberlake versus Timberlake, to regain the one and only best dancing Timberlake ever.
Yeah, I mean, I could make some DC cliche or pun related to what I do as a dance, but I'll spare you from that. And, you know, I'll take some lessons, and maybe in a year or two get back to you.
All right, sounds good. So back to deals. As a VC, right? Kind of give us, for people listening, going, you know, I really don't understand the VC model. We had someone just the other day ask me, hey, I wanted to get started in investing. I was like, okay, here's a few books, listen to the podcast show, but like, give us an overview, high level overview of the VC model for people who aren't familiar with it.
So my suggestion to people, and we have seen a company, like I said, that has raised money using this structure and on several of these platforms, which I'm not affiliated with, but there's platforms called Republic, Seed Invest, WeFunder, that allow you to invest in startups and invest, you know, anywhere from $100 to several $1,000s to create your own portfolio of venture investments. And in my view, it's a great way to learn and create a diversified portfolio and become your own venture capitalist, because they give you a fair amount of data to do your own diligence, and don't necessarily and can't, for regulatory reasons, recommend certain investments over others. You kind of have to make your own choices. So that would be my piece of advice when it comes to becoming your own, you know, angel investor or mini venture capitalist, whatever you want to call it. Because in venture capital, it's all about creating a diversified portfolio with the understanding that, let's say if you invest in 10 companies, you know, anywhere from, let's say five of those up to 7, 8 may only give you your dollar back, or only, not even give your dollar back. And so you're really investing in, let's say, 10 companies with the expectation that the top 20, 30%, it really depends on the stage and, how you're investing. But the top 20% in terms of the number of deals, so let's say the top 2 to 3% of the companies are going to drive the majority of the returns. Mm-hmm. And you're really looking for anywhere from 3 to 5 times returns on that invested capital. So let's say you invested, $10, $1 into 10 startups. You are expecting 2 to 3 of those startups to give you an aggregate $30 to $50 back in terms of your returns. And the rest will, like I said, either give you the dollar you invested in back over some period of time, or more than likely not even give you that dollar back, and the investment will go to zero. And so that's kind of really how we look at venture capital. And it's one of the few businesses when it comes to investing where you're really going to be wrong considerably more than you are going to be right in terms of a number of deals that you do. And that's a very important distinction that I like to make when you look at that versus private equity versus, putting your money in an index fund. But the ability to create above market returns, if you get it right, is considerably higher.
That is such an important factor going into it. So for a VC group, knowing, let's just say we're going to make 10 investments, we know that 2 to 3 of them may return our money back, and maybe with a 5x, 3x return. 7 of them might not make it, right? It takes a certain kind of person to get into venture capital, right? Being a GP on a fund and seeing this kind of, success and failure. What does it take to be a good VC, from your opinion?
It's a great question. And, I think one of the toughest things to balance is actually the relationships you develop with the founders.
Yeah.
Because it is a marriage. You're going to be in the trenches with these founders for 10 years, if not longer. And you don't even know really for years sometimes whether you have made a good investment. And the founders put their blood, sweat, and tears into these companies. And it is sometimes difficult to separate that from, making rational investment decisions. And so I'd say really being able to have a certain degree of compassion for founders, but also be able to make decisions in a vacuum, that is what makes a venture capitalist good at their job. And that is very hard to do as well, because at the stage of investing that we're doing, we're investing in people that we think we can work well with. And we spend a lot of time thinking about the fit between our partners and the management team, because we need to have a degree of trust and mutually aligned incentives for the next 10 to 12 years. So I'd say that is kind of one of the hardest parts, that if people are able to do that, makes them good at their jobs. The other part that can also be conflicting is pattern recognition as well. So you need to be able to realize why companies have worked in the past in similar instances and why they have failed as well. And like I said, even if you have the best conviction ideas when it comes to this, more likely than not, because of the math that I went through earlier, you are going to be wrong. But you will hope that you have found several companies that will give you above market returns because of the homework and because of the ability to recognize patterns of previous successes and apply them to new transactions, that you will get those 2 to 3 winners that will return the majority of your fund.
I love this. Compassion for the founder and the ability to make tough decisions, because it's a relationship-based thing. It's not, and I've heard this before, and anytime I hear it from a founder, I cringe. When they're raising money, like we do pitch days and crap like that, right? But when they're like, I just want I want an investor who'll show up with $1 million and then leave me the heck alone and let me run with it. I'm like, it doesn't work that way, right? Why not?
Yeah, I mean, I think there's two ways to approach it, which is interesting because you at least the way I look at it, and others will honestly disagree, is that I take what I call to be a reactive approach, meaning that I'm not going to step in day to day and micromanage from a board seat perspective. But if a founder comes to me with a specific problem or specific issue that they're working on, I'll be up, for all hours of the evening to help them work on that problem and, make sure that I can help in the best way possible. So in my view, that's better than just trying to micromanage as well. But it goes to the founder to bring you a certain issue or problem before it actually becomes something that's irreversible or very difficult to undo. Yeah. So that's kind of one way that I look at it. I mean, in terms of having an investor that's not terribly active, honestly, I don't really see that as working. And, I sometimes discourage some of our companies not to take checks from lead investors for the next round where they won't be adding value. And, sometimes we end up being right. And sometimes, passive money is not always great money. It can work in other situations. But like I said, for venture, when you're building in these companies for 10 years and it's really leaving everything you have on the line, you really need someone that's going to be as actively involved and aligned with you. And usually that's not someone that's writing a check and going away and retreating from trying to help.
Yeah. What I love when I'm working with a founder or an investment group or something is I like people who put their money where their mouth is, right? I like wealth, wisdom, right? Like I want to be able to go and be like, hey, I have no clue how to crack the code on this, market fit. I have no clue how to do that. Like, what is your experience? You've invested in 30 companies similar to mine. What am I missing here, right? Being able to ask for help, I think is super important for a founder to be able to do, and having that kind of that smart capital. And then work. Hey, I see that you guys are connected with so-and-so over there. Could you make an introduction? I would love to, see if we can do something there, right? So those are the things that I look for in a well-seasoned entrepreneur. What are some red flags, right? Those are the good parts of it. When it comes to you being a VC, looking at a company and you go, I'm out. Let's just say the numbers look good. The potential looks good, product market fit. Let's say all that, but you look at the thing and you say, I'm out. Why would that happen for you?
So ironically, I would say that if the founder is starting a company to get rich, they're in the wrong space if they're starting a startup. There's other ways to build wealth, over time, and that's honestly not starting a startup. So if people are too focused on that, are focused on the exit and even try to pitch the exit, even though we're all in the business of trying to exit our investments successfully, that is actually one common red flag. The second is not studying, at least when it comes to fintech and insurtech at this point, not studying public comps in terms of publicly traded comparables. And for the most part at this point, mainly given the regulations of fintech, et cetera, and just the fact that a lot of these companies are trying to disrupt banks and other asset managers that have been around for years, you can get a pretty good sense of what your company will be doing from a unit economic perspective at scale by looking at some of the publicly traded either growth stage companies that went public recently, or even looking at a bank and trying to look at their net interest margin if you're a lender, for instance. And most cases, they're not actually going to be that different, but you still need to know those types of economics. And for these types of spaces, we actually spend a lot of time, even if the company is pre-revenue, which may sound crazy, looking at unit economics when it comes to lending and insurance businesses, which we focus on primarily. Because we fund losses for operating expenses for these companies to grow. But if a company is fundamentally unprofitable, lending money or underwriting insurance policies, there really is no value in those companies, even at a startup level scale. So for what we do, which is pretty specialized, we really focus a lot, like I said, on the unit economics of the products. And because of regulations, a lot of times those are capped because of interest rates that you're allowed to charge, or premiums that you can charge, or ways that you can sell insurance, etc. So those are kind of two things that we look at specifically. I'd say the third example, kind of shifting more to qualitative skills, is the ability for the founder to take constructive feedback. And that doesn't mean that I am always trying to be right. And sometimes I'll make suggestions or ask questions to a founder to really test, how they react to someone, let's say, calling their baby ugly indirectly. And it's really about the way that someone responds. And you don't actually want them to just say, hey, that's a great point, I'm going to go do that tomorrow, because you don't want someone just to latch on to every idea that someone has and then completely derail the focus of their business either. So that's something as well that we try to test out during our diligence, is, how can we work together with the founders, and how do they react constructively to suggestions and feedback, and, what are those interactions like when we get to that point? Because it is that 10-year relationship where you are going to be having these tough conversations, and you want to make sure that you can have some degree of rapport on them from the beginning.
I have seen healthy and unhealthy response to constructive criticism, right? So you're asking us for money. Let's be clear, right? You're asking for money. We give some constructive criticism. How should people respond, right? Even if you're like, I just don't want them to roll over and take all the ideas with me, because that doesn't show a strong conviction to what you're working on. But how should founders respond healthily, and maybe what's a incorrect way to respond?
I'd say obviously visceral reactions or impulsive reactions, let's say, are the worst. But in my view, ironically, if someone would say, hey, I appreciate the feedback, let me go back and think about this, and then returns to you even via email, and let's say you're on a call and they don't answer the question now and they come back, that's actually the best way to do it. And they provide some pushback or some follow-up points as to why they don't believe that this is a good idea, or here's where they see issues with the suggestion, and you create a dialogue around it that kind of evolves from that specific moment. I say that's more important. At the same time, if someone, let's say, has reasons for passing on an investment, it's very difficult for you as a founder to come back and actually try to convince someone to see eye to eye if there's kind of fundamental disagreements on the course of a business. So I always recommend, when you're engaging with venture capitalists, and sometimes you can find their viewpoints from the content that they put out, or other investments they've made, or their websites, you name it. Try to find people that view the world in a similar lens as you, as opposed to trying to convince someone that has a fundamentally opposite point of view to see yours, because usually that doesn't work. And so it's really kind of thinking about those people and approaching them versus, trying to convince someone, especially at the earliest stages where you don't have much data to go on. It's all really kind of your own experiences, pattern recognition, you name it. It's easier to find people that you kind of see more eye to eye with, and then can have kind of debates about certain nuances, like I said, over time, in kind of more thoughtful, elongated conversations.
So good. I love that response of, hey, let me think about this. Like, I don't think I agree. My gut tells me this. Let me go take a look at this. I'll respond back to you. And then when they do respond back, gorgeous. It's beautiful, right? I love that. Being a VC, right? Growing up, is that what you wanted to be when you grew up?
It was not, in terms of, I had several different interests growing up. Actually, in college, I studied urban studies, and eventually, for a variety of reasons, switched to urban economics and political science, and then went to work at an investment bank where we were doing infrastructure related debt capital markets and advisory work for cities and states across the Northeast. And that was something that I was interested in given my studies, but you know, it took me a while to find venture capital. And a lot of people ask me for advice in terms of breaking into the field, whether it's fintech or venture capital. And unlike other positions within finance and even technology, there is no real right or wrong story I've found. And there is unfortunately no right place. Well, you have to be in the right place at the right time. And that's, really how I came into the field. And, it's been interesting to see, how others have come into the space as well, because there's really multiple different paths that I've seen, and there is, like I said, no clear-cut way to do this.
Yeah. So how did you crack into VC? You came from a background of investment banking, doing debt for infrastructure in big cities across the Northeast. So how did we go from that to PE to VC? Or investment banking, I should say.
So I started off at a large investment bank for 3 years in the analyst program. The logical transition at that point in time is actually to go work on the buy side in terms of at a hedge fund, or in what I was doing, more likely a PE fund as well. So I actually joined an infrastructure fund that was buying parking companies in terms of the companies that were operating the garages across the US. And so we had several companies that we did a roll up with, and then we're putting in mobile payment systems. And interestingly enough, after I left, some of these companies were actually sold to a large company that was operating cloud kitchens, of all things, because they wanted the leases of the parking facilities to basically go and operate cloud kitchens that were doing DoorDash and Uber Eats deliveries in a more expeditious manner. And as part of that, kind of after doing this, I was actually coming down to Atlanta several times a month, and long story short, met my current partner on the fund here, and we started off doing deals together. We had the name, aptly named Fintech Ventures Fund. We were doing early stage lending technology deals. And over time, it really devolved into a partnership that now we have, 20 companies in the portfolio, and have built a brand that is evolving in the banking, capital markets, and lending insurtech spaces as well. And so, it took 5 years to get to this point, and it'll take us another 5 years to learn more about our initial investments. But like I said, it was kind of an interesting path, because I don't come from a technology background per se, but I do have my whole career within financial services, and a lot of the background that I do have is relevant in terms of learning how to evaluate companies that are going and trying to, for lack of a better cliche, eat the lunch of the big banks that I used to work with and work at.
What's your superpower, Lucas? Like in a business, right? So you and I are hanging out, and we see an opportunity, and I'm like, Lucas, what are your thoughts? What is your superpower when it comes to looking at deals?
I'd say it's ironically being able to explain things quite simply, even when they're complex, in terms of on a modeling basis, et cetera. And so if you think about a lot of the companies that we invest in, their modeling when they're issuing loans is quite complex. But if you can't sit there and explain what is the equivalent of this lending company's net interest margin on 5 fingers, you're not really going to fundamentally understand the business. And so in my view, even if I understand lending and insurance to innate details, I always like to take a step back and be able to explain it to other people, like I said, with 5 simple bullet points. And I say that doesn't necessarily make me more unique than other people, but it is important, ironically, in highly complex regulated industries to be actually able to explain things and understand things on a quite rudimentary basis. So I'd say that's one of them. I'd say the second one is really the ability to, recognize patterns and being able to understand specifically why you think things will or will not work out. And a lot of the companies that we invest in, as a result, because we have this highly specialized expertise within lending and insurance, have been overlooked at the earlier stages because people did not sit there and fundamentally spend the time to understand why they could work out. And then at later stages, larger investors come in and realize that these companies, because they have revenues and traction now, are viable businesses. But these companies, some of them struggled to raise money because they were in sectors where people just did not understand them as well. Or, they've become out of favor because of poor performance of public peers, or, poor performance post-exit for some of the blue chip names that would be considered their equivalents.
As a fund, do you get involved with investor relations? Go and find new LPs, communication to them, having conversations, raising. Is that a part of your charter? Like, is that what you do?
Yeah. So, I mean, as a member of a small team, it's myself and my partner, I am doing it all. And that's one of the beauties and also frustrations of the job, is basically I will be going out and recruiting someone to join as a C-level hire for one of our companies and helping close them. I'll help close new investors for our existing companies as well. And then I'll go and, look at ways to increase our own brand presence too, which is obviously raising capital. I mean, I think a lot of people forget that a good portion of the job as a GP at a venture capital firm is always be fundraising, just like our companies. And it never really subsides either, because you're deploying funds, every couple of years as well, in terms of new ones, and having to go out and raise and talk to existing investors and new investors that you've been developing relationships with as well, because a lot of them will follow you for years before they write their first check, because they want to see that you can, find companies and see them grow and evolve over time.
Yeah, super cool. Yeah, I totally get it. Right, always be fundraising. You're always knocking on doors because you have to always be looking for new deals, which is exhausting. How many deals do you look at before you say yes and write a check?
So the rule of thumb that I learned coming into the space was that typically you'll look at 100 deals, maybe get close with, let's say, 10 of them in terms of doing more high level or, more than surface level diligence. And then you'll probably invest in, sometimes even less than one of those companies. So, it's typically less than 1% of the companies that you see do you actually invest in. And, for us, it's a little bit easier because we have a highly specialized focus to weed out deals immediately. For instance, we don't do crypto. And so we don't really spend much time looking at those deals, even though we do get them via inbound. So it's a little bit easier, but still the rule of thumb is less than 1% of the deals that we see get done. And I went actually and looked at what we had done in terms of knowing the founders and how long we know them. And for a lot of times we know the founders for over a year and kept in touch with them as well. And so it's not just a split second decision, because like I said, it's a lot of personal relationships at the pre-seed and seed stage, because there's not much in terms of data that you can evaluate. But when you go out and raise a later stage round, you have revenues, you have unit economics to show, and then the processes can be more condensed than pre-seed and seed.
So pre-seed, post-product, seed, those are kind of like the stage where you guys will make an initial look at something, right? What is too soon for you?
So there's a few ways that we look at it, at least for our space. I'd say one, non-starter, which is tough because some people do not have the means to leave their careers and start a startup and go without a paycheck for a long period of time. But for us, we found that it's alignment of incentives if the founder is completely committed and only working on their startup. So we're not really investing in people that have not left their current gig and, just have a pitch deck and no real substantive thought behind what they want to build. That's kind of more typical for what you could call the angel checks, where you go out and try to find friends and family or specific angel investors that are writing you, anywhere from 10 to, $100,000 checks into your company to basically help you develop the runway to, quit your job and work on this full time. We come in right after that, where the company typically has a product that they can show at least, mock-ups of, but, at the pre-seed level, they don't necessarily have to have generated revenues. We also invest at the seed, where we do like to see, anywhere from 0 to, 20 to 30,000 monthly revenues. But that is, a little bit later stage than where we're initially comfortable getting involved.
What is your seed threshold? Like what are they doing on a monthly basis?
So typically it can still be 0, but on average they're doing anywhere from $5,000 to $10,000 in revenue per month.
Copy that.
That's kind of how we look at it.
And that's when you'll come in kind of at a seed round.
At the seed,
Okay.
correct. And so that's when we write slightly larger checks. And then typically for the seed, you are putting a price on the money that you are investing, meaning that you are valuing the company. Whereas when you're doing pre-seed and angel investing, you typically do it on something called a SAFE or a convertible note, where you're basically offering your money as the investor, but deferring the valuation until a later point in time.
Because you have no clue. You have no clue what this thing's going to be worth at that point, right? They're pre-seed. They're figuring it out.
Yeah, and I mean that is the interesting part, because really until you find out the price that someone's willing to pay to buy you, you have no idea what these companies are worth. And someone explained it in terms of, when you are doing venture investing, you are not actually buying stock, even though you own stock. You are actually buying a call option on the company's future value, which is a very interesting way of putting it, but that actually resonates pretty well in my point of view. The other thing that is really governed by the dynamics of the market is that at each stage of investing, really from the seed, to Series A to B, you will have typical ownership thresholds that you give up, which, just based off of simple math, will determine what your valuations will be and how much you typically raise. Although, there's some deals where seeds are done at, 100 million pre, but that's really the aberration, not the norm. But that's for, serial entrepreneurs or people that have, considerable amounts of traction, and it's the first round of capital they've raised. But typically, like I said, there's some relatively narrow bands of how much people raise that gives them typically 18 months of runway, and that really factors into the valuation based off of the percentage ownership that you as a founder are giving to the venture capitalists.
Yeah, super cool. Is it typical for you guys to do multiple rounds with a group, from like, hey, got an idea, here we got going, we've got some customers lined up, to seed, then bring them to series? Like, have you guys seen that?
So the expectation is that the companies will raise multiple rounds of financing. For us, we participate in the first two typically, although sometimes we've invested at the Series A, but we're typically doing pre-seed and seed investing to get ownership that will get diluted over time.
Yep.
Ideally, and a lot of founders come and say, this will be the only round of capital we'll raise, we'll become profitable and then sell or IPO right after that. That's typically not the case. Typically, you raise multiple rounds of financing before you're acquired, or ultimately, if you struggle to raise financing, you unfortunately go out of business. And so there are multiple rounds involved with this and multiple investors. And like I said, you're raising them typically every 18 months, although sometimes it's longer, sometimes it's more near term. It really depends on the individual dynamics of the company.
I've got so many questions, but we're running out of time. So I'm going to ask you, for groups out there that do fintech, insurtech, they're building something and it's cool and it meets the investment criteria. I should ask this: where could people go to find out your investment thesis and criteria to see if they're a good fit to go in front of you? What's a good place to do that?
So we try to be transparent, and I think we are on our website. So it's www.fintech.com. And so we list out the criteria in terms of how much we invest, where we're interested in terms of sectors, geographies, you name it. I am on LinkedIn, and like I said, I do my best to respond to cold inbound if it's a potential fit. And so that's one way to get in touch. The second way that we actually do take a look is through the website. There's a contact us form, and the more information you can provide, including a deck, like I said, helps us screen pretty quickly what is a potential fit and what is not. And so that's kind of typically how we look at things too. You don't need a warm intro. Obviously, if there's someone in your network that knows myself, that's helpful because it does create some sort of social proof in that regard, but it's not 100% necessary. And several of the deals we've done have been from people reaching out cold over time and developing a relationship with them.
That's awesome, man. Two more questions before we wrap out. We run a community where we teach entrepreneurs, and we're part of the learning together. It's an EIR kind of group as a whole. And one of the members of the EIR Academy, they asked a question. Let me pose this to you. They're building a tech software that focuses on serving fix and flip investors. And I know that you were in that background in the past with fix and flip kind of world. It's kind of like a portfolio analysis where they could take pictures, they could put the cost and all that. They could see investments side by side and monitor their things. With that, what would you say as they're building this out? What would you say is the greatest threat to that kind of offer for fix and flip investors, at least during this time frame that we're in, 2022 as recording?
That's an interesting one because, obviously you could go and point to macro environments, although interestingly enough, with the correction in home prices, I would argue that actually helps flippers. Mm-hmm. And we haven't seen, despite interest rates rising, a prohibitively high increase in the cost of funding for the developers. So if you asked me this maybe 6-9 months ago, I would have pointed to some of the macro headwinds as kind of one of the main issues behind this. The second I think would be, for a lot of these platforms, especially when it comes to fix and flip finance, or I should say fix and flip project management, it's really finding an incentive or really forcing someone to use your product, whether the lender requires it or, I don't know that the contractors will require it, but it's really finding a forced adoption of your product that is probably the biggest question mark when it comes to this type of platform, because people don't necessarily want to pay probably what it's worth, and that becomes difficult unless someone that you need to complete the project is requiring you to use or pay for it. So that would be
Great
kind of my
feedback.
biggest question is, again, not knowing anything about the product, is that, you know, is it solving a big enough pain point that people are willing to pay for it versus the status quo? Because just like any of these industries, they're still comfortable doing it, via file sharing, spreadsheets,
Right.
etc. And, you know, I think it becomes interesting when you're offering certain other components like sourcing the properties, then offering this, then offering the financing. If you can do the full end-to-end process so you don't have to leave the platform or partner with someone that's doing the lending or the sourcing of these opportunities, many of which are off market, I'd say that's kind of the biggest value add or way that you could ensure that this has success.
Yeah. That is such great. I love the idea of some type of forced adoption. So we get all the investors, and the investors say, hey, before we invest hard money into your projects, you got to be on this platform, whatever. This is the way we look at our deals, or that start to finish. Great feedback there, Mr. Lucas. I appreciate
The,
that.
the one other thing I would add, I mean, you can go the other way too and basically offer it as a loss leader, but then, try to convert people into more lucrative opportunities in terms of the financing and do lead gen that way. But that's a lot more difficult to build a business on in terms of, referrals and all of that. So that's another option, but it's kind of, less viable in my view than having some sort of forced adoption as we've already talked about.
Yeah, the referral thing's interesting. You got to be able to keep the lights on in the meantime, right, till those things close if they close. But maybe the forced adoption plus the referral might be the superpower right there. Love that. I'm going to pass off that information to our member. Thank you for sharing. I think I said two more questions. So we know how to connect with you, LinkedIn and your website. Last question. During this interview, there's probably some questions just based on my inexperience. There's probably a question that I should have asked you that I screwed up and did not ask you. What question do you wish I would have asked you?
I'd say what I'm most interested in terms of themes within, fintech, prop tech, etc.
Yeah, go for it.
And, to answer my own question,
That's a
there's
great question, by the way.
no, I
We should have
appreciate
a
it.
show. You're doing good.
I'll leave that to you. But in terms of what I think is most interesting now, and it kind of goes back to the wave 2.0 we've seen for crowdfunding of real estate, but it's a completely separate area of fintech, is that initially you saw a wave of companies trying to disrupt the legacy banks and financial institutions. But now you've seen a wave, really, let's say only in the last 3 years as well, partially because they were forced to undergo more rapid forms of digital transformation, is serving technology is serving community banks to help them remain competitive versus neobanks that are fintech competitors, and then also versus the bulge brackets that have much larger budgets on technology. And you can just go look up what JP Morgan has publicly come out and said that they're going to spend on technology, and it's a lot. And so there's several thousand community banks that need to invest in this type of technology. Same with credit unions. And fintech is really starting to solve that pain point, especially when it comes to loan origination and helping a lot of the banks solve what they have being a deposit problem and needing to make money on those deposits by obviously lending it out. So that's kind of what we've been most interested in recently, is software that relates to lending or to helping them maximize the returns on the assets that they hold on their books.
Yeah. That is one of the so love that question. I love what you're looking at, right? Like a lot of people, the founder in me, right? The startup founder in me sees the big the big whatever and wants to go after Goliath, right? Another approach, and that's sometimes you win, probably not, right? Another approach, if you want to disrupt something, take a long-term approach. How do I serve the smaller underdogs who are trying to compete first, and then join up with them, serve them, build a software that helps the community, banks, help them with their deposit issues. Super awesome, man. I like the way you describe that and explain that. Good job.
Yeah, unfortunately, it doesn't necessarily work in terms of real estate because a lot of the lending that people are doing, whether it's on the commercial side, I'm sure, as you know, and obviously on the SFR fix and flip lending side, it's not really stuff that banks will even do because of the regulatory constraints as well. So it's kind of more so when it comes to consumer lending or conforming mortgages, you name it, that we're really seeing this type of investment in technology from the banks.
Yeah. Awesome. Awesome. Well, we got to wrap up. Fellow deal makers, thanks for listening in with Lucas Timberlake, not Justin, but we're going to have a dance off in maybe a few years. If you have some deals that you want to put before them, go take a look at their investment thesis and the hypothesis on their website. And if it matches up, reach out to them. They have a contact form and say, hey, heard you on the Deal Scout show. Please take a look at my deal. I'd like your advice on this deal. And if you have a deal that you'd like to talk about here on the Deal Scout, head over to thedealscout.com, fill out a quick form. Maybe we could talk about a deal that you're working on or the kind of deals that you like to invest in. The show's mission and purpose is to put deals and deal makers together. So let's do that. Hope you guys have a great day. We'll talk to you all on the next episode. Bye, everybody.